Hey, happy Wednesday afternoon to everybody. Time for managing an options portfolio. My name is Brent Moores. Glad that you're here. We're going to talk about kind of how different strategies, different option strategies may impact your account, your portfolio. So we're going to do that next. I'm joined alongside Mr. Cameron May, who I've worked with Cam for over 20 years now, so we know each other well, and I've a great admirer of Cam and his stuff. So make sure you check out some of his webcasts there as well, and also follow him on X at Cameron May CS. Follow me on X at Brent Moore CS, and Cam is also on LinkedIn. You can follow Cam on LinkedIn as well. He'll put his LinkedIn handle. Do you call it a handle on LinkedIn? There as well. But hey, before we get too far into this, let me just mention a few important things. One, options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And rolling strategies can entail additional transaction costs, including multiple contract fees. The material is intended for general informational purposes only, and it's not an individual recommendation or personalized investment advice. Paper money software application is provided for educational purposes only, and Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risks, including the loss of principal. Past performance is no guarantee of future results. There we go. See some familiar names in the chat. Glad to have you there. And if you're watching on a recording, we're glad you're there too. So let's take a look. This is the S&P 500. And it's had a nice little recovery. It had a pullback, but we bounced up strong. And today, hey, we're up better part of 1% today. So relatively strong day. Just a reminder, the markets are closed tomorrow for the Thanksgiving holiday, but we've crossed back above the 20 and back above the 50-day moving average. If I extended my resistance line, we've broken above that as well. So some short-term strength momentum in the market. If we were to, I'm not going to take the time to do it. If we were to pull up a MACD or an RSI, you'd see some upward momentum on that as well. But the reality is, for our purposes, you don't even need that. You can see the nice big 4 green candles in a row here. And so a lot of stocks are kind of following suit. And when you're doing that, of course, you have the choice of what kind of trade you're going to do in the market here. Sometimes a trend hasn't been established that long. In this case, I'm going to look at Kraft Heinz. And we had a pretty clear downtrend actually on this, but it does appear that it's changing. This would be kind of a key potential resistance level, but now we have a higher low and a higher high. So I'm going to look for a bullish trade on there. And of course, you have a choice of different bullish trades that you can do. One that maybe we don't talk about as much as others are synthetics. And so I want to talk about a long synthetic trade and then use that as a launching point for a broader discussion on strategy selection. But what a long synthetic is, well, what's a synthetic? Think about synthetic things in your life. Synthetic oil is kind of a substitute for traditional just oil. A synthetic is just something that's meant to substitute an original. Well, in the case of a long synthetic, it's meant to mimic a stock trade, mimic what a stock does. Now, it doesn't do that perfectly. Okay? It does not do it perfectly. For example, if you own a stock, you may receive a dividend. Okay? If you have a long synthetic stock trade, you're not going to receive a dividend. Okay? If you own a stock, you can just kind of own it indefinitely and it's not going to expire. It may go bankrupt or something like that, it may go out of business, be delisted, but it's not going to expire. You don't have expiration dates on stock ownership. With synthetics, you do. And synthetics are a more leveraged type trade. But let's just look at this. So if I go here and let's just say, hey, I'm expecting this trend to go up, and let me get rid of an older trade there I have there. And I'm going to pick an expiration. We'll go up 50 days on this maybe. And I'm just going to go at the money. Well, what do we got? 25 is the closest thing we have to at the money here. So I'm going to look to buy the 25 call. I'm just going to click on that. I'm going to look to sell the 25 put. I'm going to hold down my control key. That way we're adding both in there. It's going to cost us about 50 bucks. You're going, well, 50 bucks compared to 100 shares of stock, which would cost us about $2,600 there. And, but what's our delta? Okay, remember delta tells us how much something is likely to move in relationship to a $1 move in the underlying stock price. Let me just analyze this trade. Let me go to analyze, go to risk profile. There we go. Okay, that's what it looks like. What's my delta on this trade? About 102. What's the delta on a stock trade? If I just bought 100 shares of stock, it'd be 100. That's one of the things with synthetics is you end up with the delta that is approximately equal to the stock, around 100 there in that case, 100 shares of stock. And that's usually our launching point there. And now, that's great. You can say, well, hey, spending $50 out of pocket on this, and I get the same potential gains. This is essentially what a graph, a risk profile graph of the stock would look like. I won't take the time to do that, but if I were, that's what it would look like. Pretty close. And so you spend 50 bucks and you can still make essentially the same amount of money as the stock. Sounds great. But keep in mind, you can spend 50 bucks and you can still lose the same amount of money on the stock there. So it's a leveraged investment there on that. And so that's something I want to just kind of make sure we point out, first of all. Secondly, let me just move this out of the way here. Secondly, let's look at the Greeks. If I look at the Greeks on this, delta we already said is about 100. My theta, yeah, there's a little bit of theta here. It may be a little positive, a little theta, negative, just depends on the strikes you use there. But the point is, this is going to be a very small amount. Our vega is going to be a very small amount. Gamma is going to be pretty small. Really, the Greeks aren't usually massively significant here on this, but the delta is going to be around 100. Okay, so that's an approach to trading. And let me I just want to adjust this so our bottom of our screen is not cut off. And I did not help. I think I made that worse. Did I? Come on. Hold on one quick sec here. Why that is, well, anyway, there you go. Okay. So let's talk about different trades and their impact on the portfolio. So we just did a long, make sure I remember to send that, synthetic, okay? And the approximate delta on that is, it's approx, these are all going to be approximates. So delta is going to be about 100. Now, you guys are familiar likely with long calls. What's our delta on that? Well, our delta is just going to depend on what strike price we pick, of course, but very often we'll go in the money on that a little bit. So approximate delta, I'll just say maybe 50 to 70. Again, approximation, you can go as high as you want on that, but that's kind of a pretty typical one. What about a long call vertical? Long call vertical, I'll abbreviate here. And what's my delta going to be on that? Remember, we got a long strike, a short strike. Oh, I don't know, maybe 30 to 50-ish or so. Again, ish on all these. They may be a little higher, maybe a little bit lower, just depends on the strikes. These are all bullish trades I've done so far. Everything I've done so far, it has a positive delta. I'm not putting a positive sign in front of those, but just realize those are positive deltas. Well, we'll say, oh, I don't know, maybe a 20 delta on a short put vertical, maybe a little less, I don't know, something like that. Okay, so if you're looking for bullish trades, this may be something to consider. How bullish are you? The more bullish, maybe you want to push it to a higher delta. If you're more bullish on a trade, you may opt more for long calls rather than a short put vertical, for example. Okay. If you're more bullish on a trade, maybe you do long calls instead of long call verticals. Now, there are other considerations, of course, such as risk, maybe, right? You may be limiting your risk when you go to one of your spreads. But this is a key thing. Furthermore, it's not all good because you may have a forecast of a bullish trade, and sure enough, it may go south on you. Has that ever happened to you? Well, if it hasn't, it's because you haven't traded much. Because it's inevitable. You're going to be wrong on this. And so keep in mind, you're upping your risk there if you go to the higher deltas. But let's move on here. And I have something else to say here. So let me do calendars. We'll say butterflies. We'll say iron condors. Delta, these are trades we'd all kind of categorize as delta neutral. Now, they're not going to be exactly delta neutral. They may be a little positive, a little negative, but generally we're going to call those roughly neutral trades. So I'm going to put a 0 there on the on that. Okay, let's scroll down. Let's go. Then we can go to, let's keep on going down. Let's go to a short call vertical. Okay. What happened to my caps lock? B, short call vertical. Okay, so this is going to be approximately negative 20. We go maybe a long put vertical. We're going to say maybe approximately negative 30 to negative 50. Notice these are just analogous to the bullish versions of those. And I can go on down the list, and just for completeness, we will do a long put, and we're going to say, again, it kind of just depends what strikes you pick, negative 50 to negative 70. The more bearish you are, you'll probably opt for something that has a higher negative delta there. Okay, so we're going to say a short synthetic, which is going to be a negative 100. So there we go. There's other things we could put in there. And hey, JDML said, hey, you could sell a put. Yeah, I didn't put that in here. If you sell a put, where would I put that? I'd probably put that kind of in this range. Let me just say short put. And probably often traders will look something like a maybe negative 30 delta on that or so. Okay. So now, question. On a vertical, you have two deltas. Which one do I mean? I mean on all of these trades, I mean the combined delta. So if I do a short put vertical, let's consider a short put vertical here for a sec. I'm probably going to sell something with has maybe a 35 delta, and I'm going to buy something with maybe a 20 or 15 delta. So you sum them up, positive 15, and you end up with a 20 delta difference there on. Okay, so that would be the net delta of those two. Same thing with these. Typically, we're going to do short put verticals out of the money. We do short call verticals out of the money. And that accounts for the delta differences on those. Okay, so when I included in both strikes on the verticals there. That's why those deltas are typically lower on those. And there we go. So is delta good or bad? Well, no, it adds the risk element to it, right? So if I knew the stock were going to go up, then I'd do higher deltas. If I knew the stock were going to go down, I do higher negative deltas or lower deltas, I guess is the way to say that. There's another element too that I'm not going to really discuss that much today, and I'm not even going to include it on the spreadsheet, but there's something that we could call beta, right? Beta tells you approximately how much that stock may move. What's the volatility of the stock? So if I have a higher beta stock, couple that with a higher delta, I end up with higher potential gains. Also, higher potential losses, because the movement is typically, this is a historic measure, it's not a guarantee of what's going to happen in the future with beta, but that it may be a factor. If I take a more of a steady Eddie type stock, something that just doesn't move much with a lower beta, then the stock's going to move less, likely, and therefore the movements that we're going to see, even with the similar delta, is probably going to be less there. So there's more to the equation than just delta. There's what stock you're doing, but that can affect things. Now, let's move to the next step, okay? Let's take a stock, and actually I want to, before I go too far on this, I'm going to send this trade. And this is a synthetic, so I'm going to put this in my synthetics category, okay? And it's thinking. We'll see if that fills. We can always push that later if we want on there. So let me go here. I'm going to go to our long single options, and I just kind of want to look at an example here on this of something that we have that's at a delta that's gotten higher than when we entered, okay? One rule that we have often used in this webcast is when we buy a long call or a long put, we often will start with something like a 60 delta, and we talked about what the implications are on that. But then if it gets up to something like maybe an 85 delta, then we'll roll it back down. Okay, we'll roll it back down to the lower delta. Why would we do that? Well, the reality is, if we knew for sure that the stock was going to continue up, now it only got up in the first place, it only goes from the 60 delta to the 85 delta if the stock is going up anyway. But if it's going up, it goes up to, say, the 85-ish delta, and we roll it back down. Why would we do that? Well, let me say this. First of all, if we knew for sure it was going to continue to go up, then we would stick with the higher delta, okay? Because we would benefit. We would make more money if the stock continued to go up. But what it enables us to do is, number one, it enables us to take a credit, okay? By rolling down, in other words, and we'll talk more about what the rolling process is here in a minute, but by rolling down, we're able to sell at the higher delta, buy again at the lower delta. It's going to be cheaper. Therefore, that's going to generate a credit. Taking some money off the table, so to speak. Taking some risk off the table in that regard. That's a good thing. Secondly, we're kind of de-leveraging in a sense. In other words, that way, if the stock does reverse on us, and it's already gone up quite a bit, and I think a lot of you have experienced this. Stock has gone up quite a bit, and then often it takes a breather and comes back down a little bit, okay? So if it does do that, then we're liable to take less of a hit on the pullback. So those are kind of a couple reasons to do that. And maybe one other reason, perhaps, is the farther a stock goes in the money or out of the money, the farther an option goes in the money or out of the money, the liquidity sometimes gets a little thinner and you get a little more slippage on those prices there. So maybe it's kind of nipping that in the bud just a little bit there. So anyway, let's let's do this. Let's look just at the history of Caterpillar here in a sec and just kind of see what that looked like. Let me go to account statement. Let me go to trade history. Here's Caterpillar. So this was the original trade on Caterpillar, so we can kind of see what we got. Originally, we bought this. This was a leap, okay? So this is kind of working out longer term. This is out to January 2027, so this is still over a year away. We bought it for about 70 bucks. Caterpillar cooperated beautifully, okay? It went up just what we wanted. And what we did is we sold, you can see this, we sold that 330 call. We sold it for 163. That was great. What did we do at the time? We bought the 450 call. We rolled it up actually to a different strike, to the lower delta. Okay. And it cost us $80 in that case. And you can see these two, the credit right there, you can see the credit right there. Now, by doing these in one transaction, that's the roll, okay? It doesn't save us commissions on that. One nice thing is, though, it kind of gives us one line item there, and we can see what the credits are along the way. And we'll look at another one as well later where the credits may not always, we may not have always rolled it exactly in one ticket, and therefore you got to kind of do a little math and subtract one from the other to do that. But in any case, and it's not a huge step, it's not a big deal, but if you do the rolling, then you can get that. You can see that right there on that one ticket there. Okay, so that's what, yeah. Dragon Rider said, you're buying and selling at the same time. Yep, we did this all at the same time. We got out of the one, got it in the other. That's, rolling isn't anything really special. You're doing it at the same time. You're doing it on one ticket, but essentially you could just sell out of one and buy the other. Okay, that's how you do it. All right, and so let's go back. Is it time to roll again? Well, no, if we stick with our rules, we're at about an 80 delta, and we said before we're going to do about an 85 delta. So we'll wait a little bit on that. Now, one note of caution, and we'll talk about beta weighting in a different session, but if you're beta weighted up here, these deltas are going to change. You can't be beta weighted if you want to see your deltas there. If I beta weight this, let me just put that into SPX. You're going to see, oh, my delta is all messed up on that there, okay? So we're not going to do that today. So that's Caterpillar. Now, we're not just going to get out. I mean, this has worked out great, wonderful. We're also going to have a stop on your long options. Long calls, long puts, very typically stops are used. Well, what do we have on this? We have a 125 stop on this right now. And the option right now is 163. So stop seems a reasonable level right now. Have we turned bearish on Caterpillar? If we turn bearish, we'll probably just get out and take our profits. I would not call that bearish at all. I think the trend seems fairly strong. That can certainly change at any moment, but we're just going to stick with Caterpillar here on this. Okay, let's continue. Let's look at lows. This is a long option. This is a long put. This is a bearish trade and one that's not going so well. We're losing some money on this. In fact, today's not a good day on this. Notice we do not have a stop on lows. We maybe need to reevaluate that because likely we're going to want to call there. Okay. Now, Ricebird said we could move the stop up. Yes, we can. Let me go back to Caterpillar for one sec because that's probably a question some of you have. Can we move the stop up? Yeah, we can. Right now, the stop was, I forgot, it was like 125, I think. And 125 on a 163 option isn't unreasonable, I think. A 50% stop would be about 80 on that, okay? 125, you know, we're probably like at a 75% stop level on that, somewhere in that range, which is that. So you could probably tighten it up a little bit if you want, but probably not that much from there. Typically, we're not going to go to like a 90% stop on those. That's usually a little tight for a long option, okay? But this is one where we don't have a stop, lows, and it's going against us. Let's just take a look on the chart. We still have a little time to go on this. We're planning on a bearish trade. Here's lows. And you could probably see why maybe we thought it was going to go bearish. Well, but, you know, the greatest plans of mice and men, man, that things have changed. And this had two really very bullish days in a row here on this, okay? And Greg saying this started as a different trade. Well, at this point, it doesn't really matter how it started, in a sense, in that now we have a long put and we're going to need to reevaluate this trade here at this point. So what I'm going to do here is going to say, well, look, we either get out now. I was looking at this earlier today and was going to suggest, hey, if we start to break above our, kind of draw a line in the sand and break above our moving average, well, now I've waited enough time here. It actually has broken above the moving average. So we'd have two choices on this. If we want to see if we're going to stay, we're going to use this maybe as a resistance, it's still, jury's probably still out a little bit on that. We could put a tight stop in here on this, or we could just get out. Okay, I could be persuaded either way on that. For our purposes, I think I'm just going to get out because we're now breaking above our moving average. So I'm going to create a closing order. We're going to take our lumps here. We lost a little money on this trade. Alas, that happens. And I'm just going to get out of that trade. If you wanted to, if you were playing along at home, you could indeed decide to stay with that. But probably, I think for our purposes, we'd be looking at adding a stop in there on that. Okay, so we're going to do long single options. I think that's it on long single options. The other two are newer trades that don't need any management. Let's look to a different type of trade here. Let's look at some short verticals here. Okay. Let's look at, I want to look at Apple and Amazon. One we're doing well on and one we're not doing well on. Okay. So Apple, when do we get out of a trade? If we still have some time, this is a short vertical. This is a short put vertical. We want the stock to stay above the 265 level. And we've got some time, 23 days to go. When would we consider managing? Well, number one, obviously, if time got less, under 10 days, we'd look to get out. If we turn bearish on it, that would be a reason. Are we bearish on Apple? Let's pull up Apple. Okay. Okay. Bearish? No, I would not say. I think traditional technical analysis would say, hey, we're still looking relatively bullish on this. If I want, I could say, well, maybe there's some support in this level, but more importantly, I would say that's not even the most important thing. I would say our trend is up. We have these clear higher lows. This is our kind of support level on that. That certainly makes sense. And moving average could act as support on this. And so I think we stick with it from that standpoint. If we've made most of what we can make on this, then we would, 80% of what we can make on it maybe, then we would look to get out of the trade. Because at that point, we've made most of what we can make and our risk is still the same on the trade, right? Doesn't matter how things are going. If the stock craters on us, we could still lose the whole amount. But in this case, we still have a fair amount to make. If you'd like, you can have a PL percentage column on your chart, on your page there. Another thing you can do is, look, we entered this trade for about, what is that? About $1.20. That's our initial trade price. I'm just taking the difference between the $2 and the $2.80 and the $4. And it's currently at about 50 cents. Okay. So clearly it's doing well. That's great. But certainly not at 80%. Okay. 80% would be about 24 cents or so. Okay. So we're going to stick with Apple. We're going to let that go. Our time decay should be helping us out. There's our theta on that. Now, this one's a little more challenging. Amazon. This is one is not doing so hot. We still have some time to go on this. We are losing money. This is, again, is a bullish trade. It's a short put vertical. We do have a stop on it though. Okay. We do have a stop. Let's see what our stop is on Amazon. Here's Amazon. It's a conditional order. Less than 215. Okay. Less than or equal to 215 we're getting out of this. Let me go here. Move this. Let's look at Amazon, see where we're at. AMZN. Okay. 215. So we bounced down. Our stop. Wow. Okay. Look at that. Let me zoom in just so you can see it a little better. Our stop level, our exit level, that's probably as close as I can get without doing it, was right there. We barely, I mean, that is as close as you can get probably to not getting caught out. And it's actually, it turned out this way. I mean, sometimes people will say, what's the downside to a stop? You should always have a stop. Well, this kind of illustrates it actually. If this went down like a few cents more, we would have been stopped out, and we've actually recovered quite a bit. It was worse. Now, we may still want to add a stop. Keep in mind that with vertical spreads, this is a short put vertical. Sometimes traders won't even use a stop, which is fine. The reason you're doing the spread is you're limiting the risk in the first place. But if you want to add a stop, you can. Now, at this point, we could say, well, it did that. Maybe I want to put my stop a little tighter, man. I'm going to go to where our recent bounces were, which is around, what, 222 or so? And maybe add it, move my stop up a little bit on that, if I'm going to stick with this. Right now, it seems to have some upward momentum. So I'm going to stick with this, but I'm going to move that stop up to about 222 on that, just to try, and if it does reverse on us again, to get us out and limit the losses here on this. So I'm going to